So in this chapter, we're going to go over the basics of accounting. First thing is that we need to understand why do we need accounting information. Basically, in any business, there are multiple decisions that you have to take. Maybe you have to decide whether I should open a new factory or whether I should purchase new machinery or how much inventory should I keep. So all of these decisions require accounting information. The accounting process begins with accounting information that is passed on to decision makers so that they can make decisions, actions, and then those actions would become economic activities, and the accounting process will keep on going in circles. So the main focus of accounting information is that it should help in decision making. Now, what are the basic functions of an accounting system? It is to interpret and record business transactions, to classify similar transactions into useful reports, and thirdly, it is to summarize and communicate information to decision makers. External users of accounting information are those parties that require accounting information so that they can make decisions. Now we can see over here, we have owners. Actually, owners are internal users of the information. Owners would require this information to see whether the amount they have invested has given them profit or they should take their investment to someplace else. Creditors would want accounting information so that they can see whether they should give more credit to the business or not. Then you have potential investors, which are the people that might be interested in investing in your business. And of course, they will not invest until and unless you show it to them that you have good profitability ratios. Then you can have labor unions, you can have suppliers, customers, trade associations, general public. So all of these people, in short, are interested in accounting information. Now, what are the three primary financial statements? So we have balance sheet, which tells you what is the net worth of the business. We'll go into detail later on what exactly do we mean by net worth. Then the second statement is your income statement, which will tell you about the revenue and expenses for a designated period of time. And third one is your statement of cash flows, which tells you the ways that cash has changed during a designated period of time. Now, I would like you to note over here that for cash flow statement, we have written for a designated period of time. And similarly, for income statement, it was also stated that it is for a period of time. Whereas for balance sheet, it was written at a specific date. This is a very key difference between a balance sheet and the other financial statements. Balance sheet is for a particular point in time. It means like you're taking a picture at a snapshot at a particular date. So I want to know what are the assets, liabilities, and equity situation. What is my net worth of the business at, let's say, 31st December. So it is telling you the position of the business on that date, 31st December only. Whereas income statement and cash flow statement both are a period of time, which means that they're going to show you, the income statement is going to show you the revenue and expenses that the business incurred from 1st January till 31st December for the whole year. It's not for a point in time, it is for the whole duration of the year. Similarly, the statement of cash flows will tell you how cash is increased or decreased over that 1 year time period. Now, the time periods in accounting can be 1 year, they can be semi-annual, they can be quarterly. It depends what is your designated period of time for which you're making the statement. Another important concept before we proceed is business entity. The business entity concept says that the accounts of the business and the owners are separate. So a business entity means that when we are recording accounting transactions, we have to treat business as a separate entity from that of its owners. And so therefore, if an owner is investing money into the business, we say that even though the money is obviously reducing with the owner, it is actually increasing with the business. So if the owner is investing business money into the business, we say that the cash in the business has increased. We're not going to record the fact that the owner will have less amount of money, because we're not concerned with what is happening with the owner. We are only concerned with what is going to happen with the business. Now, this is our starting point. This is a statement of financial position, also known as balance sheet. And you can see that this side shows the assets, whereas the other side is showing you the summary of liability and owner's equity. And over here we have a date. So for Vagabond Travel Agency, this is telling you what are the assets, liabilities, and owner's equity of this business on the date December 31st, 2009. On this particular date, this is the situation of the business. Now, over here, you can also see that the asset side total actually is equal to the total that is coming from the liability and owner's equity side. So a balance sheet, as the name suggests, should always balance. Now we'll go into detail what each of the terminologies mean. So what do we mean by assets, liability, and owner's equity? Let's begin with assets. Assets are economic resources that are owned by the business and are expected to benefit future operations. So asset is basically the business's resource that they own. Whenever you want to start any business, you will always require some sort of an asset. For example, if you want to start your textile manufacturing business, then you would require machines for it, you would require premises for it, you would require inventory for it. Inventory would include the cloth that you have that you want to turn into garments. So these are all of the things that a business requires. Without these assets, a business cannot operate at all. So these are your assets, and you can see that what kind of things are included. You have cash, you have notes receivable, accounts receivable, supplies, land, building, office equipment. Now, the other things are easy to understand, but I would like to explain to you what do we mean by accounts receivable and notes receivable. Accounts receivable are basically your customers that have not yet paid. So it means that you have done sales with them, but the customers have still not given you the amount of money. So you're going to receive the money in the future. Now, because you're going to receive the money in the future, it is actually an asset. As you can see, an asset's definition means that you are going to expect a benefit in the future operations. So even though it means that I have sold something, let's say we have over here 60,500. So I sold something from 60,500, but the customer is saying that I'm not going to pay you in cash, I'm going to pay you 1 month later. So because in the future, I expect I'm going to get money, that is a benefit that I will get in the future. So this is an asset for me, because even if I'm not getting the cash right now, I will get it in the future. Similarly is the concept of notes receivable. So notes receivable means that you have actually loaned the money to somebody else, and now that person is going to give that amount back to you in the future. Now, moving ahead about assets. A very important concept for assets is that they are recorded at their historical cost. This is called the cost principle, which means that assets are not recorded at their market value, but at the value at which you have purchased them. So if I bought a machinery for, let's say, 100,000, I'm going to record it at 100,000, regardless that the machinery is now worth of 70,000 or that machinery is now worth of 150,000. I am just going to record it at the cost at which I have purchased it. This is also called the historical principle, which means you're going to record it at the historical cost. Then what are liabilities? So now we're going on the other side of the balance sheet, which is your liabilities. They are the debts that represent negative future cash flows for the enterprise. So they are basically cash outflows. Money is going to flow out of the business in the future. In other words, it simply means that it's a loan. Now, what kind of things we have? We have notes payable, account payable, salary payable. So you can see liabilities are usually denoted by the word payable. Payable means that you're going to pay them in the future. And because you're going to pay them in the future, it is a money that you owe to somebody else. So accounts payable are basically your suppliers from which you have purchased your inventory, but you have still not paid for them. So let's taking the textile manufacturing business. They are the people from which I have purchased my cloth and I have still not paid them. I'm going to pay them in the future. So it's a liability that I have to pay. Similarly, salaries payable means that people have worked for you, but you have still not paid them the salaries. You're going to pay them in the future. That's why it's a liability on you. It's a loan on you. Notes payable is also a type of loan that you take. We'll discuss what is notes payable in the later videos, but right now you just need to understand this is also a type of loan that you take. It's a certificate. So you're going to get money and that you have to pay in the future, and usually you pay interest on your notes payable. And then we have the last section, which is your owner's equity. Owner's equity is the owner's claim on the assets of the business. In other words, it is the amount of money that is invested by the owners of the business. And you can see over here, there are two main categories over here, capital stock and retained earnings. By capital stock, because we're studying company accounts, you need to understand that in company, when a business requires money from the owners, it is through shares. So if a company requires money, they're going to sell shares on the stock market. Investors will purchase those shares. So automatically when investors are purchasing those shares, the money is going to go to the company. This is when the company does an IPO. Later on, if the investors are trading among themselves, that money does not go to the company. However, the initial public offering, the first time that the company is selling the shares to the market, the money goes to the company. So this capital stock represents the amount of money that is raised through selling of shares. And then retained earning is the amount of money, the amount of profit that has been retained in the business, that has been reinvested back into the business since the beginning of the business. You need to understand that whatever profit the business earns, it belongs to the owners. So if the owners are not going to take out that amount of money out of the business and it is being reinvested back, it has to represent that the owner's equity, the amount of money that is being invested by the owners, is increasing because of that. Now you can see that your assets total should equal the total of your total liabilities and your owner's equity. This is called your accounting equation, and this is the basis of your whole accounting. So this is your asset side total, which was 300,000. This is your liability section total, which is 80,000, and this is your owner's equity section total, which is 220,000. So 220,000 plus 80,000 will also give you 300,000. So your accounting equation should always balance. It should always be equal. Now let me explain this to you in more detail. So like I said, when you want to start a business, you would require assets. So if I want to start my own business, I know that I need to invest an amount of money because I would have to purchase inventory, I would have to purchase my premises, I would have to purchase fixtures, furniture, these kind of things for my business. So these assets require money. The first thing that I'm going to try to attempt is to use my own savings to purchase those assets. So the amount of money that is coming from the owners, that is your owner's equity. So let's say I invested 220,000 from my own money. However, I still required more amount of money and I ran out of cash. So now another option for me is that I can go and take on loan from the market so that I can purchase even more assets for my business. So if I have taken on an 80,000 loan, then my assets are now 300,000. So in other words, there are only two ways you can finance your assets in the business. Either the owners are going to invest their own money, which is called your owner's equity, or they are going to take on loan.